Hey folks, it's John again. This is going to be a very quick video, but a very important video. Because when you're talking about putting money away, everyone always wants to talk about the return on your investment, the average rate of return. Now, we have a whole video that blows away the myth of an average rate of return and how you can actually have a positive average rate of return and lose a bunch of money. Okay, so what I want to talk about here is much more bottom line. How much am I going to put in and how much can I take out? And will I have to pay tax on it? Let's talk about just those three things. What I did was I went and ran an example illustration, and I thought, okay, if you had a 45-year-old man and he wanted to know what it would look like if he put $20,000 a year inside an investment grade whole life policy for 20 years and then pulled out income till he was age 90, what would that look like? And on this board is what it looks like. So very quickly, here's the way it works. $20,000 per year for 20 years. It's obviously $400,000 going into the policy. That's through age 65. Now, starting on age 66, he's going to pull $41,100 a year out, tax-free, for income. So $41,100 per year coming out. That's going to be through age 90. So folks, if you take $41,100 times 25 years, which is what this is, he's going to pull out $1,027,000 and some change. Now, let's assume at age 91 he passes away. He's still going to leave behind $178,000 additional tax-free money for his family, above and beyond what's still left out of the over $1 million he withdrew out of the policy. He did this on a 100% tax-free basis. So to pull out triple the amount of money you're putting in this policy, and to do it on a tax-free basis, folks, I don't care what anybody says, that's a very solid use of some of this gentleman's assets. He's not putting a fortune in here. $20,000 a year is not a fortune. He's probably putting money elsewhere. But he knows that with almost no risk, let's look at that for a minute. What kind of risk is involved here? Putting money inside a whole life insurance policy is one of the safest things you can do based on almost a couple hundred years of financial history. So it's not putting it in the risky market. It's not hey, if the market does really well, you're going to be able to take this out. This is I just basically ran an illustration showing what would happen if an old insurance company paid out dividends, the same dividend they're paying out today. What would that look like over the next 20 years? So very low risk. On top of that, it's not like he doesn't have access to the money. Remember, when he puts that first $20,000 in, he could volumize and velocitize, let's say, starting $14,000. So he's got access to $14,000 of his first 20, and it only gets better from there. So what happens if he starts borrowing out this money and paying it back with interest, with additional interest? That's more money going in. That means more growth in dividends, which means the final numbers, assuming that those original loans get paid back and they get paid back with interest, folks, you're looking at way more money than I've even illustrated on the board. This just shows money going in, you not touching it until age 66, and then the gentleman borrows it out, withdraws it, or does policy loans. We have what the difference is in our frequently asked questions video. But he withdraws income out of this thing till age 90, right? Over $1 million of it, and when you add in the death benefit, $1.2 million he gets to take out of this for himself and his family on putting in $400,000 over a long period of time, $20,000 a year, and he didn't even give up access to the money. Folks, at the end, when he started taking money out, there was $660,000 of cash. So he had way more money than he put in the first place. But now he gets to take this out and withdraw dividends over a longer period of time, takes out a substantial amount of money, all tax-free, still leaves behind a nice chunk of money for his family. Nothing wrong with this. So thanks for stopping by today. We'll see you on the next video. You can also fill out information for a quick application right here on this site. Go ahead and do that. And we can also run your own personal numbers. Maybe you can put in more. Maybe you have to put in less. Maybe you can only fund it for 10 years or 15 years. Maybe you can do 30 years. It all depends on your age. So all of these numbers will change, but this is a pretty solid way to put in $20,000 a year towards your retirement and, big and, not give up access to the cash. Thanks for stopping by. We'll talk to you soon.